Hello and welcome to another economic and RBA update. I'm joined here by my co-host Evan Lucas.
It's good to be back in the studio.
It has been great to be back in the studio. Hey, we've got a big show today. It's 2:15. We've got around 15 minutes before we get the RBA's rate call. So we're going to take that live and then we're going to basically talk through all of that data. And we're also going to take a little bit of a deep dive into the property story that's emerging in the spring selling season, a few of the animal spirits that are also out in the marketplace as well.
Yep.
So we'll be talking to that also. So let's get in. Let's start with the Australian economic update. So as I said, we'll take the 2:30 announcement for the cash rate. We'll see that and see how that rolls out. What we wanted to do firstly, though, is to talk to some of the changes since the August rate call. So we've seen the monthly inflation read come in for August is a little bit hotter than most people predicted. And then that's obviously in terms of the general read, the CPI read. Core inflation, which strips out some of those more volatile items and is the RBA's preferred indicator, moved closer to its midpoint. So we saw that and we'll talk more to that at around the sort of 2.6 down from 2.7. And then what we wanted to talk about prior to the RBA rate call today is take a look at our GDP results for Q2. So that's up until the end of the June quarter. So we've got a few charts to sort of talk to here. So I'll just get us set up here. The Australian economy grew by 0.6 quarter on quarter, accelerating from an upwardly revised 0.3 in Q1 and topic market consensus of a 0.5 increase. This was the 15th straight quarterly rise, and it was driven by domestic demand, final demand, I should say, which was up. Household consumption jumped also higher. This was due to higher spending on discretionary and essential goods during the Easter and Anzac Day holiday periods. Government spending also picked up, as did the social benefits and national defence spending were the two main areas of spending by government. Net trade added increases as well as exports were also up and they outpaced the imports during that time. So on a yearly basis, the GDP has grown by 1.8% above forecast and a 1.6% and the fastest pace since Q3 of 2023. And Evan, you've got some data that we want to basically talk to.
Yeah, so before we go any further, Ben said before, this is to June. So don't forget, this is a lagging indicator, but it will have 2 rate cuts in it, but only just. The May one was mid-May, and realistically, it's only had 6 weeks into the figures. So this is the movements that we've seen with 1.5 rate cuts. And so everything that kept coming on the negative basis of GDP was around that per capita, also referred to as real GDP. So when you strip out migration, etc., was that we had 7 consecutive quarters of negative per capita growth. So we were in a per capita recession.
We were.
And stuck in it.
Yep.
Not only that, before that, we'd only seen, as you can see again from the chart, 8 of the previous 7 were, there's only one of the previous 8 was a positive. We've now started to see a change, and the change is there. Yes, it's still volatile, you can see that, but per capita GDP is actually now moving in the right direction. And it should start to slow down in terms of that volatility that's moving between, negative and positive numbers.
Yep.
And then I wanted to also show us against the rest of the world and comparable players too. So I would probably say we're doing better than our bigger players, being Canada, the UK, New Zealand's obviously technically possibly in recession. Now, just give you a heads up, the reason there's an asterisk there, we don't get their second half numbers until next week. So it's a little bit out of the numbers. But in saying that, our comparable economies, we're actually doing better than, yes, the US is there. Singapore is also a very interesting one. But overall, on a real capita GDP basis, we're okay. Yeah. It's not great. No. But we're okay.
No, good on Taiwan and Singapore shooting the lights out.
Correct.
And Spain's found its groove.
Yeah, which is not, it was coming from a very low base.
Yeah, exactly.
But what I also then wanted to go into a bit further on it was to sort of show you that putting population back in, they are a big part of
Yep.
this story in a good way. I think at the moment there is this lazy bit of politics of linking migration and immigration to the property story, which you're going to go through later,
Yep.
because it's not that simple.
No.
Yes, they put some pressure, but nowhere near the level of pressure that is driving it in real terms. And then also you can see it's a horrible color, but that sort of grey, browny sort of drop down that we've seen through 2022-3 to where we are now is finally gone back into the black. Productivity GDP is actually now adding to growth rather than coming out of it. And so overall, the tide is turning in a good way. It's not at a level that would make the economy really hum, but it's not contracting, and it's not showing signs that what's going on over in Trump land, what's going on in Europe, and to some extent even what's going on with our biggest trading partner in China, we are getting through it because once again, we are a lucky country for good reasons. We make our own luck is how I like to sort of turn around and say it. And our GDP shows you that we are still doing better than our major competitors, and we are still doing better than most other nations.
Yeah, and population growth and immigration is a net positive for us. It's really important to understand that the luck that we've created is off the back of the human capital, and that human capital has been a combination of obviously greater birth rates over death rates, but also this positive migration story and immigration story that we're seeing. So I just hope that the politics is poor, the nationalist politics is ill-informed in terms of that. And coming back to New Zealand is a perfect case. When you get so much change and reform and social democracy over there like they had, they've got everyone leaving, coming to Australia because the jobs are here. So unfortunately, the problem with economic cycles is you can make them worse through some of the regulation that you put in. And then if the jobs aren't here, people aren't going to wait around for the jobs to come. So it just makes it hard to get that economic flywheel turning again. So all of those New Zealanders who can come and work in Australia, don't need a visa or a permit to do that, are on the bus and, on the planes and are over here.
Yeah, and this again, Ben just said the most core part of it. They're contributing to the economy.
Yes.
So this is what I think is also lost, and why I say it's lazy politics. The impact that immigration has positively on the upside they're putting into productivity is there. Some will argue, you're getting low-level productivity because you're getting low-level migration. That's to some extent that is.
We could do better with who we're bringing in.
Correct.
Skilled, non-skilled. Agreed. Yep.
The other flip side on that, though, is that some of the skills that we are lacking in, they are here, but under our regulation, they can't be used
because they don't have the permits.
Correct.
In other words, their qualifications
are not recognised.
Aren't recognised here.
And so all of this is part of the debate. And so you talked also though at the start about what's happening in the numbers around public versus private, and that's why this chart I had to include.
Yeah,
it's something that I know you've been very strong on. But what also shows you there, this trend of government spending over and above everything else, it's been going for a decade. Right? If you look at that line, you can see end of 2015, 2016 is when it took off. And realistically, if you take that scenario from the household, away it's gone. And the expansion is incredible in terms of where it sits.
It's gobsmackingly incredible. Like if you think about, COVID hit in 2020. And so we obviously had all of this additional support spending to keep the economy alive when we were in lockdowns and closures. And, even though the economy was dormant, people were still getting paid their wages, which was essential. But we just haven't slowed it down.
No.
So, but, and there will be great debates around economists and people that we mingle with where we are talking about, has the government done a good enough job to make this, because you can see some positives here.
Yeah.
Like that has meant full employment pretty much.
Yep.
And so that has ultimately meant that there's been less of a economic correction or economic slowdown. But on the flip side of that coin, there's always trade-offs. The trade-offs meant that we had higher interest rates for longer to get in front of inflation, because we basically still had people or demand coming from consumers, which meant that inflation story has continued to grow. So when you start thinking about that, you've got to be thinking about, insurers and all of these other people, businesses were able to on-sell and on-charge those service fees as part of that, in terms of that story.
And the other thing that should be highlighted in this chart that is also good news, that really thick black blue line, that navy blue line on household spending is starting to actually move back. It's starting to go back towards trend. And what's also important from an RBA perspective is that they have known they need the consumer to come back. They need spending to pick up if we want to get out of the anemic growth scenario that we've had. That worm line had to go back towards trend, and it's starting to do that.
Yeah, because what follows that traditionally is also then the consumer spending, the business spending. So once the consumer is showing signs of willingness to spend, then businesses start to invest in materials, in human capital. All of those things start to flow through, right? And that's the problem with when you try and stall an economy. So the government is arguing that they've done a good job of keeping the economy active, but it's cost us a record level of debt. And so we've got to pay that back with interest at some point into the future. So I think it's important to understand.
After the RBA sort of release, which is coming up in about 2 or 3 minutes' time, we will go through the inflation story. Because the other thing about what Ben's alluding to that we are starting to see with the budget updates, etc., is that spending does need to be met with revenue.
Yeah.
We have just got the 24-25 budget update. And you can see, even though we've just had a record tax take, the spending levels that we've got, it was at 85, 86 levels, which is extraordinary in the spending. It's the care economy, yes, with what we now demand.
Correct.
But in saying that, it is also showing signs of being unsustainable, having a deficit when we just got a record level of you, me, and everyone out there working, tax take, company tax being higher than expected, superannuation tax being higher than expected, and then as Treasury consistently has done over the last 3 decades, which is under deliver with pricing around coal and iron ore, and over delivering on price. So just to give you a heads up, iron ore assumptions by Treasury since 2015 has been double digit between
$50 a ton.
Yep, between $50 a ton
at 55,
and has got up to 75.
Oh yeah, and now it's sitting over 100. Hey, so, can I also make another point there, Evan, in terms of the other thing that's important here is, so obviously when the government puts the money in the economy, it doesn't get lost, right? It goes into wages and it falls through into profits, and there's obviously GST and all of those other things there. And we do know that with rising prices, that certainly from investors, if some of these older investors start selling their properties, there's going to be a huge capital gain take that the government's also going to enjoy as part of that. But our argument here is really simple. We want to see more of that private investment, that business investment, and that type of spending. So the burden isn't on the government, because the more that they do spend, and then the more of that debt that has to be serviced, or the interest bill on that debt that has to be serviced by the tax take, just makes life a lot more difficult. So we want to start seeing surpluses. Otherwise we'll be a very, very heavily taxed country, and that taxation is really a drag on economic activity. And that's why when you look at our GDP numbers, they're so sluggish generally. I mean, you can still see the US is still outstripping us, and it's the biggest economy in the world. So a big economy like that can move forward at a quicker pace than what we can, is always challenging for mine.
Now, I'm fully aware we are, 35 seconds away from the RBA. So we'll keep moving on that. We'll come back to some of that in a minute. But the other thing that we probably need to say, expectations.
On hold.
Yeah.
That's why we haven't even built it up.
Yeah, and we haven't even spoken about it for a deliberate reason, because what's about to happen is clearly that it's going to be on hold, but it will now bring us to what we're going to probably talk about for the next 10, 15 minutes. And depending on how big it is, could be even longer, the statement and whether or not November is a live event and what it actually looks like. So we haven't got to inflation. We'll get to that in a minute. In fact, actually, we'll go onto the website now because we're 5 seconds away, and we'll have a look. And as expected, the RBA should now.
Let's have a look and see what we've got. Let's see if it updates. Still waiting for an update.
So September 30.
September 30.
Come on.
Here we go. Maybe your watch is a fraction
no.
fast. Maybe there we go.
There it is.
So basically it's moved on to effective date, which is tomorrow.
Yeah.
But the cash rate remains on hold.
That's what we expected. But what we now want to do is to have a very decent read of the statement. And I'm going to get onto it now.
We're going to go through that. And then whilst Evan's doing that, so there's the chart. Cash rate remains on hold, 3.6. I suspect what we'll see in some of that particular information, and we'll do a comparison shortly, is that you're going to see that they're waiting for the quarterly inflation read because the monthly inflation data is a little bit inconsistent. So while Evan's we're busy at that, I'm going to talk to you about this inflation story, and then we're going to come back and talk to the statement. So first things first, the monthly consumer price index, CPI rose by 3 year-on-year to August, which was up by 2.8% in July and above expectations of a 2.9% gain, but remaining within the RBA's 2 to 3% target range. This was the highest inflation reading since July of 2024, given preliminaries by rising house costs. Housing inflation rose by 4.5% from 3.6% in July, marking the 14-month high. That was driven with spikes in increases of 24.6% surge in electricity prices. We're going to talk about that. And some state government rebates expired. Inflation also accelerated for clothing, 3% versus 2.3, communications 1.9 versus 0.8, whilst transport prices rebounded 0.4 versus negative 1%, marking the first increase in 7 months due to a softer decline in fuel prices. On the flip side, annual trim mean inflation eased slightly to 2.6%. We said we would mention that earlier. So that's down to 2.6 from 2.7% in July. So that's the trim mean, which is what the RBA is ultimately always looking at. So Evan, over to you, and I'm going to see if I can bring this statement up.
So several things have caught my attention immediately reading through it. So in the opening major paragraph, not the one that obviously tells you that they're leaving the numbers at the current level, we are going through from the point of view that you look at the recent data, while partial and volatile, suggests that inflation in the September quarter may be higher than expected at the time of the August statement on monetary policy. That is their wiggle room. So that therefore means that November is alive, with alive being a possible hold.
Yes.
Right? Rather than what is currently forecasted, which is that we think they are going to be looking at the idea that they are going to be cutting rates. And that is the big change that we can see here with regards to what's going on in the difference between the previous statement and the one we've got for. The next thing to also have a look at is the next paragraph. Data for the June quarter showed that private demand is recovering a little bit more rapidly than expected. In particular, private consumption is picking up in real household income rises. Financial conditions are also easing. They then go on to say, but productivity growth has been weak and growth in the unit labour area has also been weak. Then the other thing to go on to, and we'll probably come into this a little bit more later with you, Ben, with around, they mention very clearly the housing market is strengthening, a sign that recent interest rate decreases are having an effect. Credit is readily available, and both households and businesses are taking that up. That, for me, is a big part of the statement as well. What I will now look at while you go through a few other bits and pieces, because I actually think what they're saying there, they have given themselves more than wiggle room. They are giving themselves some pretty decent headroom to hold on in November. And I'm just going to go quickly and check the Aussie dollar, because from my perspective, of what I'm reading right now, this is neutral. Wouldn't say it's hawkish, but this is quite neutral in terms of what it says. And I think the interpretation of this is that not only is November live, the probability of a cut, I think, now fall below 50% with regards to how it's seen, which also means, stick this in your diary, everyone, the 29th of October. That is the next release of the quarterly inflation data. Stick it in your diary, because it now looks like, with what's coming out in this and what we can see with all of these changes, which are quite vast from what we saw in the August numbers to what we are today, is that will be a make or break. Has the September, partial volatility we've seen in the August figures meant that inflation is no longer heading back to not just the midpoint, but towards the bottom end of the band? Has it started to stall? Has the 3 rate cuts that we've already had not only started to filter through, but also brought through forward behaviours and brought our confidence up? Let's talk about all that, because I think the next thing to go through, I'll keep going through the statement for you guys, and I will dive into it where I see important things. But I think, Ben, for you, the housing point, the fact that they're talking about the private consumption confidence numbers being interesting,
Yeah.
because the data that we've just seen over the last 6 weeks somewhat matches us with this, but not completely.
No, well, I think that there's a couple of things for me. First one is, am I seeing the sort of level of inflationary pressure that was around 12, 18 months ago? No, I'm not. What are the factors driving that? I mean, are there any demand shocks? Are there any supply shocks? No, not. I think what's happening is the consumer is spending, and certainly in the services side, a full employment market and probably a bit of market sentiment has actually been positive in those numbers. So I'm waiting for the quarterly number. I still think, in my mind, it's probably still towards a move. I certainly would want to see the economy growing at a stronger clip than it currently is. And remember, these rate cuts take up to 6 months to actually effectively move through the market. So I'm still slightly optimistic of a cut in November as part of that story. But we will continue on whilst Evan continues to keep doing his deep dive. So I'll just minimize that and move back into the charts. So the second one we want to look at is the unemployment and participation rate. So this is, remember, we always go GDP to have a look at the backstory and the history. Then we go into inflation to see what that means for the cash rate. Then we're looking at the employment story. Remember, the RBA has a dual mandate. So the unemployment rate stayed at 4.2% in August, unchanged from its previous month and in line with market expectation. The number of unemployed people fell by 900, bringing the total to 647,400. Among them, those seeking part-time work declined by 3,600 to 204,000, whilst those looking for full-time jobs increased to 3,000 to a reading of 443,000. In terms of employment unexpectedly declined by 5,400 to 14.63 million, missing forecasts of a 22,000 increase, following an upwardly revised gain of 26,500 in July and marking the first decline in 3 months. Full-time employment decreased by 40,900 to 10.08 million, while part-time employment increased by 35,500 to 4.55 million. The participation rate, which also makes the adjustment of the overall the overall unemployment rate, declined to 66.8, just below the market expectations of 67, marking the lowest since March of this year. The underemployment rate edged down to 5.7 from 5.8. So from an employment story, there's a cooling going on here. There's definitely a cooling. And if you look at the ANZ forward estimates around new advertised jobs, it's not shooting the lights out by any stretch of the imagination. And that's definitely got to be playing a part in terms of where the unemployment rate gets to. Is it 4.4, 4.5 at the peak, or are we going to hold this 4.2, 4.3 period?
You would assume with what's going on, it's going to ease up a bit further. Like you will probably get to 4.5%. And so,
yeah, looking at the sentiment stuff, this is where like everyone was surprised. We're still in pessimistic territory. Everyone thought that off the back of the confidence and the economy moving, and basically the rate cuts, the 3 we've already had this year, that we'd be seeing this move, but ultimately it fell backwards. Where the consumer sentiment.
September was expected to be the first time we broke through that 100-point mark, that optimism and pessimism level, in over 3 years, and we went backwards by 3.1. Westpac described it quite interestingly that we are optimistically pessimistic. Yes. That was actually the title of the paper. So again, what's fascinating, and Ben's highlighted there, is have a look at the family finances next 12 months and also versus a year ago. So versus a year ago, we're quite pessimistic and have been, and historically are, right? But if we look at the next 12 months, we're actually above trend at 107. Trend is 106.
Yeah.
So we're optimistic about our own personal family finances over the next 12 months, but have gone back into negative territory around the economic conditions for the next 12 months, the next 5 years, and then time to buy a household item went from an optimistic time to actually. Hang on.
Oh, it's not. It's this battle between positive sentiment in the property market versus affordability, and it getting too much high, because you can see there in terms of house price expectation index also moved to a record high. Or an elevated 15-year high, I should say, of 168.4. So that says to you that everyone believes property prices are going higher, and we're going to unpack the conditions to say that they're probably right. But the point we're trying to make here is affordability is still stretching some. and not everyone's enjoying the benefits of a full labour market at the moment. Things aren't quite where they need to be, and that's where my mind is still that that 3.6% cash rate is still a restrictive rate. It's not a neutral rate, and so at some point we've got to pull the trigger on that.
And just to show you, I know that's hard to have a look on here, but the reason I bring up this is the Australian dollar versus the US dollar, and you can see that it is ratcheted higher since we started talking, which again, as I said, reading this statement, there are signs to think that they may be...
They've just pulled back a little instead of a stronger signal.
And holding on it, because the other thing to then have a look at is what they said in the last part. And we're about to come up to talking around business confidence and where that sits. And it's the final one. With signs private demand is recovering, indications that inflation may be persistent in some areas and labour market conditions, which we've just spoken about, remaining overall stable. The board decided it was appropriate to maintain the cash rate at current levels, blah, blah, blah.
Unanimous.
Financial conditions have eased since the beginning of the year, and it seems to be having some impact, but it will take some time. This is the thing I think they're also picking up. It will take some time to see the full effects of earlier cash rate reductions.
That's where they're buying, more wiggle room, because that's because if consumers have this wealth effect and think they're okay and they get out spending,
and they think more are coming,
and that gives business the permission to lift prices, which is inflationary. So we might have,
we may be saying this could be the last time for 2025.
Could be. I mean, NAB obviously did make their adjustments, but look, I'm hoping that that's not the case. So I do think that if we want a stronger economy,
it needs at least two more.
It does. It does.
But I think, as I said, reading this, the board remains alert to heightened levels of uncertainty on the outlook, and it noted that monetary policy is well placed to respond decisively to international developments if they were to materialise. So this is more wiggle room. Remember what Philip Lowe used to call it? You need to have the ammunition in
you need to have a little bit of
blah,
extra.
blah, blah. Now, they've got a lot extra.
They've got some gunpowder in there.
But this, as I said, everybody thought this would happen, but again, this is probably stronger in its views around...
Well, it's just making sure that if they do decide to hold when expectations are for a cut, that they've told you in September that they're giving themselves the wiggle room.
I'm going to put a slightly controversial jawboning.
Signaling to the market? They're not allowed to do that. Anyway, I know that
jawboning.
Governor Bullock's got an interesting press conference coming up, because that's how she's going to walk this tightrope in terms of what if she's going to lead, she doesn't want to lead, she doesn't want to signal. So that's going to be an interesting one. I think that's what she'll have to say.
Hopefully in the November one, I'll be back up there and I'll be sitting in the front row asking some questions about what has come up, because I think the November meeting is going to be fascinating.
All right, let's move on, because it does make it very much a live meeting. So NAB Consumer Confidence Index fell to a 3-month low. So this is what we're talking before. It's declining to a reading of 4 in August, down from an upwardly revised 8 in the prior month. So that's a big correction, which has been the highest since August of 2022. Also, business conditions did improve. So this is the positive. So let's go through those. 7 v 5 in July, aided by steady sales. So this is that spending, consumer spending, at 12. Stronger forward orders edged up, 1 versus 0. Moving into positive territory the first time in 2 years, whilst capacity utilisation rose 83.1% to 82.5. Purchased goods rose at a quarterly pace of just 1.1, the lowest since 2021. A good sign for softer inflation pressures moving forward. Retail price growth halved to 0.5, while labour cost growth eased to 1.5 from 1.9. So we do like labour costs going down. They're all of the input costs which put pressure on inflation going down. NAB's chief economist, Sally Auld, said regions and industries that have faced headwinds in recent years were showing improvement, boosting confidence that the broader economy is in a stronger trajectory in second half of year 2025. She added that cyclical sensitivity sectors, including manufacturing and retail, also saw gains in both confidence and conditions when she went down deeper into the data. So again, that says that the economy is okay, and potentially we might just have to wait. Now, I wanted to, I promised at the start we want to do a bit of a, it's into the spring selling season. Effectively from tomorrow, we've got another boost in demand coming from the 5% guarantee, which will help first home buyers get into the market. So I want to start with lending, because this is the important story here, right? So I want to just So you can see here, this is showing the value. Now remember, value of new finances is the price that we pay. So naturally this can increase quickly if prices are going higher because they've got to borrow more money. So I'm always interested in the volume, right? So the volume for me is the count of the number of new loans. And this is where it becomes really interesting, because we saw that the value and the volume of new home loan commitments rose in the June quarter, up 1.9% and 2% respectively. So we've got value growing at 1.9, sorry, volume at 1.9 and value at 2%. Here's where the interesting bit for me is investors drove the increase in volume, with loan commitments rising 3.5% over the quarter compared to 0.9% lift for owner-occupiers. Now that's 3.8 times faster that the volume of investment lending is growing compared to owner-occupiers in the last quarter. Now that for me is a concern. And if we look at this next chart, we can see here what I'm talking about. So you can see, look at the 10-year average. So this is the 10-year average marks on different markets. Now we know the ACT have regulated themselves out of being attractive for property investors, so we're not going there. The ACT government, you have to use all of the residents' money to raise taxes to build social housing. That's their problem. Okay, Northern Territory is on a tear. Right? We said at the start of the year that this was the market that we thought would do the best from a price point of view because it had been so stagnant for so long. But look at it's being driven by investors. So what are the fundamental economic drivers that the Northern Territory got to sustain that growth? Or is this going to be fool's gold? Is this going to be a classic case of those who get in now are going to be swimming naked in a couple of years' time? Definitely going to be one to watch. Tassie, you can see that they're only just inching above their long-term average. WA's on a tear and still 36%. The difference with WA is their economy's great. Their debt levels are in good shape. It's being well run. They've got positive population growth, so they're in good shape. South Australia is still sort of running quite warm, warmer than I expected it to be this time of the year. I actually thought that would cool down a little bit. And also you can see here in terms of Queensland's also running very, very strong as well. Victoria, again, taxing themselves out of competition here in terms of attracting those investors' dollars. They're coming, but the money that's coming in is other investors getting out and taking their profits. And then New South Wales, but you can see there over the long term, that's been a very positive market for investors, especially coming into the unit market. Okay, that unit market, and there's a lot of foreign money that also comes into that unit market as well. And so they're also investment dollars as part of that. So nationally, we're 37%. Now, here is the point I want to make about this. At the end of the day, property investing should always be, in residential property, investors should always be a price taker, not a price maker. You will get yourself into long-term trouble if you are the reason why property prices are going higher. So if you're buying in regional towns or cheaper areas or whatever, be very, very careful about what the fundamentals are saying around what is the long-term price growth in those particular markets. Because as I said, I am worried about those who have been swimming naked when the tide comes out because of these animal spirits that we're seeing in the market. Now, why are those animal spirits around? Well, if you look at the number of new listings, and you can see the thick line is the current year, that we're below the sort of long-term 5-year average, and the last couple of years have been pretty good. So we're fallen below that. But then when you look at total listings, you can also see, let me break that down in terms of new listings. Did I just jump one chart? There it is. That's the one I wanted to look at. So this is the total listings, right? So here's our problem. So you can see back here, we had, the new listings, which is showing signs of market coming good, but the actual number is significantly lower. And this is where you get that breakdown. There is only 2 markets. This is only new listings, and this would be off a very low base for regional Northern Territory. You're talking about Alice Springs and Katherine as basically being those 2 markets. Yep. So very, very low numbers. So that's why you get such a big percentage. But then you see, regional Tasmania, everything else is in declining supply territory. So the conditions are rife. And then when you look at the approval story, right, in terms of where is the cavalry arriving, well, they're also below some of their longer term averages, their decade averages. So we're hoping for a building boom to happen here. Once we've finished our infrastructure boom, we need to move all of those tradies over into a residential building boom, and hopefully we'll start to see that supply arriving. Because if we don't, we've got conditions of high demand, softer supply, and so that bodes well for future price growth. Now, we'll get the Cotality's data for the September results tomorrow as we're recording this live, but we can see here's a snapshot of stuff that they have published via their website. So you can see here, we're probably looking at a 0.7, maybe a 0.8 sort of national increase. Even a 0.9 is also coming into play with those numbers because this data was taken over the weekend. But you can see that, some of the movement. So the rising tide is definitely lifting all ships when it comes to price movement across the country. And so we need to be mindful of that. But what we're trying to say to you is who's driving it? Because we want owner-occupiers to drive it. We don't necessarily want investors to drive it because you're going to have some volatility in future prices if it's all about investors. Finally, rounding it out, this is the annual change in rents. We know that housing is certainly in terms of construction, as well as the rents make up around 23% of the basket. So we are starting to see, inflation coming into
and that's the RBA's problem.
Yeah,
right?
It is.
It's a big part, the housing sector part of the inflation figure, and that is showing that if it's growing at 4.1%, that's a problem.
So this is, obviously, as for the property investor, our costs of running our private rental accommodation businesses have exploded when it comes to higher interest rates, higher insurances, higher minimum standards that they want to, and higher taxes. You put all of those things in play, we are passing those costs on because we can, because we have to, but there's also no supply that says you can't slow us down in terms of doing that. So I've been saying publicly that you want to be looking at with your rental reviews between 3 and 5%, because the other problem that we have is the regulator would potentially come in if you want to do the right thing by your client, your tenant, in terms of that, and you don't put the rents up for a couple of years, and then you want to put a 10 or a 12% increase, the regulators are going to stop you from doing that. So you are better off introducing or baking in this type of thing, because again, these are the unintended consequences of the regulation that we have in the market. So that just gives you a bit of an idea in terms of how we're looking at the economy. Let's wrap up Australia and then move in to the other markets. So November rate call is absolutely live and now is on a knife's edge.
And by live to be a hold rather than being what was probably seen as a fairly reasonable foregone conclusion that they were going to cut rates. That is why it's live. It's live to a hold rather than a live to a cut.
Okay, then we got the Australian economy is doing okay. Like we talked about, we do need more of that private investment rather than government spending. Property market is set to grow further and led by these animal spirits. And so we do think that there needs to be some consideration in terms of what's happening around watching that market closely. So let's now move into the US of A and have a look at what we see there. So let's start with the current data around the quarterly GDP. So the US economy expanded by an annualized 3.8%, much higher than the 3.3% in the second estimate, and marking the strongest performance since Q3 of 2023. The stronger than anticipated figure primarily reflects an upward revision to consumer spending. The PCE rose 2.5% versus 1.6% in the second estimate, led by a bigger revision for services, which was 2.6% versus 1.2%, while spending on goods remained robust, 2.2% versus 2.4%. Fixed investment was also revised higher, 4.4% versus 3.3% in the second estimate, including equipment, which is 8.5% versus 4.7%. Those data centers and those, and AI costs a lot of money. Intellectual property products, 15% versus 12.8%. It is on a tear. And structures, 7.5% versus negative 8.9%. So we are seeing a revolution happening. It's the new economy. It's the AI economy that's coming through there, and that's going to show up in the forward estimates. We're talking about $1 trillion of investment just in the US alone in terms of energy, data centers, and then fulfillment of AI around the world off the back of that. Residential investment, however, fell 5.1% versus 4.7%. So it's not spreading across the economy. It's very concentrated. Also, government consumption shrank slightly at negative 0.1% versus negative 0.2%.
I found that interesting because clearly, obviously, what we've been trying to see is, part of Doge has been around the whole idea of government consumption falling. it's certainly not at the level they were hoping.
Well, no, they've obviously got the tax cuts that are also going to kick in as well. So that's probably balancing that out a little bit. Because remember, the big beautiful bill had more debt than it had savings. So that's probably why we're also seeing that. On the other hand, contributions to net trade was revised lower. Exports declined at the faster pace, negative 1.8 versus 1.3, and imports fell. Tariffs, imports fell 29.3%. Versus 29.8. So they were down slightly, but they were still negative in terms of what that story looks like. Let's look at the annual inflation. So you can see here the annual inflation rate accelerated to 2.9%, the highest since that time. So we're also then starting to look at, this is their problem, in terms of since January, after holding at 2.7 in both June and July and in line with market expectation, prices rose faster for food, used cars, trucks, new vehicles. Also, energy costs increased for the first time in 7 months. Prices for gasoline was still negative 6.6, but worse than negative 9.5. Fuel oils decreased less than the rise in natural gas prices remaining elevated. Meanwhile, inflation steadied for transportation services and slowed slightly for shelter, 3.6 versus 3.7.
So 3 things to pick up that have been part of the changes that have happened pretty much since the April Liberation Day tariffs. First and foremost, one of the other policies that the Trump administration has implemented on day one was the deportation of illegal immigrants.
Yes.
Don't forget, the majority of those work in food agricultural businesses.
Yep.
So the 3.2% jump is also coincides with the 2.9 that happened in June and July. It was growing by 1.8% the month before. They're having a labour cost crisis.
Naturally.
So that was one. The other one that was interesting, you and I spoke about this the last time, that is now actually flaring up again. GM's actually put out a big statement. The deal that he's done with the European Union and with Japan.
And Canada and Mexico.
Yep. Well, not yet. So Canada and Mexico is the problem in the fact that GM and Ford get a lot of their parts from Canada and from Mexico.
Yes.
Which have astronomical tariffs on them with the issue around NAFTA and all that kind of stuff.
Yep.
What he's done is effectively actually make the European Union and Japanese cars at the moment, and I'll give him that credit, at the moment more competitive because the tariff was set at 15%.
Mm-hmm.
The overall impact on US manufactured good cars with Canadian and Mexican import parts is that it's actually about 22. So Ford and GM products are more expensive than European and Japanese car manufactured cars.
Because he's making a bet to say, come and build them here.
Correct.
And do them with the latest technology and robots to make them competitive.
That also explains why used cars, trucks, etc. are on the way up, because demand for used cars, which are still technically cheaper, are on the way back up. It's what we saw during COVID, where they couldn't manufacture. Used cars went through the roof. And the reason that I'm talking about, GM is now talking about the fact that their manufacturing is the lowest level it's been in 4 years. So COVID times.
Yeah. And that's showing up also the unemployment. They're the unintended consequences and they're the trade-offs.
The best way I've heard it, if you were to squeeze a toothpaste.
Look at it.
Yeah, but if you squeeze toothpaste in the middle, obviously you're going to push to other ends.
Yeah.
So the cause of what you're doing with that squeeze is hard to understand where exactly in the tube it's going to pop up.
Yeah.
But it's going to pop up.
It's got to move. You're moving the dial in some. That is the trade-offs and judgment calls that have got to be made. So what did the Fed do? Obviously, they've changed their tune a little bit, in terms of worrying about inflation. So the Fed have cut the federal funds rate by 25 basis points early this month on the 17th of September at their meeting, bringing the cash rate range to 4 to 4.25%, in line with expectation. Now, this is the first reduction in borrowing costs since December of last year. Newly appointed Governor Stephen Moran stood alone in voting for a 50 basis points cut instead of a 25-point movement. So
not just that, you can also see him in the dot plots.
Predictable.
But you can also see him, like there's
absolutely
all of them here, and then there's a dot down here, and it's him. Again, we don't have time to, but the issue around Lisa Cook, which is obviously the governor that he is trying to fire, this is what Ben and I were talking about this offline. I'm not going to say it online, but this is the concern. This is the
of course it is.
The spread of having a interfering government into what should be a technocratical, whether you like it or not, completely at arm's length handling of policy because they are not skewed by politics. They are not
Correct.
skewed by other areas. They are there to do one thing, which is to move inflation to 2% in the States, or here 2 to 3%. And they've got one lever, and that's what they do. Rightly or wrongly, like it or don't, doesn't matter. That's what they do, and they do it well. And that's why institutions like central banks work.
Yeah. Well, their independence is essential.
Yeah, because they have a mandate, and it's written
correct
in
dual
law.
mandate.
That's it.
2% cash rate. Sorry, 2%
inflation rate.
Inflation rate, and obviously full employment, or as full as they can get it.
Yep.
And so, what did we just see? Inflation moving higher. So, are they going to make the case that it's a transitory because it's a one-off because tariffs are going to roll through and then it'll be okay?
If
they're going to argue that artificial intelligence is going to make everything more productive, and
if you read their statement, they are very aware that they think inflation is coming. They needed to move it because inflation was there, and more importantly, growth is moving the wrong way. That 3.8 jump in that revised figure wasn't out when they did the change.
Well, let's have a look at their new updated economic forecast that we also got. So we saw the Fed expected lower interest rates by another 50 basis points by the end of 2025 and a quarter point in 2026. So we're talking about 75 basis points movement, slightly more than expected that in their June forecast. GDP growth projections were revised higher for the remainder of this year, so 1.6 versus 1.4, seen in the June projection. And then in 2026, they've revised them up from 1.6 to 1.8, and in 2027, up from 1.8 to 1.9. Now, if you talk to Besson, he's talking about GDP running at 3%.
Mm-hmm.
So he's saying that you haven't seen anything yet of what we've got. The commitments from the international people coming in and basically accelerating. We're going to have basically cheaper cost of electricity. We are going to see a surge in the demand for energy off the back of these AI agents and so forth. So that's really interesting. Then they talked about the core inflation projection was also left at 3.1% for 2025. So they're saying we'll see inflation higher. Now, their big question is, are they going to accept inflation at 3%, which is off their mandate of 2%? That is the big question, and that's the political pressure that's being applied on them in terms of that. They revised that in 2026 down to 2.6 from 2.4. So ultimately, are they giving up on their 2% mandate? I think that's a fair question to ask Jerome Powell and the board. The unemployment rate also continues to be expected at 4.5% for the remainder of 2025, but is revised lower to 4.4 from 4.5 for next year. So they're expecting that once this tariff bump, if they're going to call it that, settles itself down, and with this rejuvenation of investment into the US led by their technology dominance, that they're going to see, they're going to thread the needle, so to speak. That's basically their bet. We'll see what plays out. All right, let's now look at unemployment, because this is the ultimate story. You can see the trend line on the chart here for those of you who are watching on YouTube. For those who are listening on audio, the trend line is really clear that unemployment is on the way up. So US unemployment rose by 4.3% in August, up from 4.2% for previous month, aligning with market expectations to reflect the highest portion of joblessness since October of 2021. So is this the pain that they have to go through before they get out the other side? The number of unemployed increased by 148,000 to 7.384 million in the period. In turn, the labour forces increased by 436 to 170.778 million, driving the labour force participation rate to increase by 0.1 percentage point from the over 2-year low in the previous months at 62.3. The broader U6 unemployment rate, which includes discouraged workers and those working part-time for economic reasons, rose to 8.1% from 7.9 in July. And remembering that Fed has that dual mandate of inflation and employment. So what are they going after here? Are they going to go after the employment story and take a bit of heat on inflation? It looks so.
Yep.
All right, let's move on now to consumer confidence and sentiment. And so we saw the University of Michigan consumer sentiment for the US, because this is the other piece of the equation. Like we get the sound bites coming out of the US, but this is what the consumer's telling us over there. That they're not very happy. So you saw that the sentiment was revised lower at 55.1 in September from a preliminary 55.1 and compared to a 58.2 in August. So it's definitely stepped off. This marked the second consecutive monthly decrease, pushing sentiment to its lowest level since May. The gauge of expectations was revised down to 51.7 from 51.8, and the current conditions sub-index was revised lower to 60.4 from 61.2. So what we're seeing here is, and remember, anything above 50 is still expansionary, but it's not necessarily floating in the pace level to get that sort of magical 3%.
Historically, Americans are quite optimistic, and historically, this figure actually sits well and truly above that optimism point. So the average 10-year figure, I'm pretty sure when I last looked at the Michigan numbers, was 62.
Yeah.
So I think it needs to be put into how it is that they are optimistically pessimistic, let's use Westpac's terms, in the fact that they are always fairly optimistic, but they are below the
greatest country in the world.
They are below standard.
Okay, business confidence on the other point, and this is where we do see the challenge, because what we might see is there might be 10 or 20 or 30 businesses creaming it globally off the back of technology and innovation and satellites and space rockets and defense. The rest of the economy is doing a bit tough. These sort of trade tariffs and so forth aren't necessarily flowing through. So we saw the IMS US manufacturing PMI increase to 48.7 in August from 48 in July, though it fell short of market expectations of a reading of 49. The index signaled the sixth straight month of contraction as a sharp drop in production, 47.8 versus 51.4, was only partly offset by a rebound in new orders, 51.4 versus 47.1. So we're seeing employment continuing to fall. Customer inventories are also falling. Then we've also got the gauge for price inflation ease. That's a good sign, but still remained elevated in the sort of mid-60s overall. Surveys respondents overwhelmingly pointed to tariffs as a drag on business conditions, citing higher costs, supply chain disruptions, and reduced competitiveness. And you talked about that.
Mm-hmm.
This deal with China still isn't done.
Yeah.
And so why would I put orders that on the ship could cost me a lot more when they arrive?
And on that, in the 6 weeks since we've last done one of these, there has been no suggestion that the two sides are talking, like almost none. We were leading up to the last RBA meeting, hearing at least that they're going to have to move the 90-day tariff. It's almost open-ended in terms of where it is, because they said it will get through August. There wasn't a date put on it, and then we'll reevaluate. Well, we're starting October tomorrow, and there is nothing of any sign that Beijing or Washington, not only are they talking to each other, but that there's any sign of a deal that will be created.
Yeah.
So this could be the story of 2025, that we just have this open-ended freezing.
Might be worth booking a trip to America next year if they're, if you've got the Aussie dollar still holding high because of the cash rate and the US dollar falling because of their lower interest rates. Anyway, the Fed is moving on interest rates. We're seeing them signal that now. The dot plot basically says that equity markets are at record highs. That bodes well, actually, for what we call it, the wealth effect. So people feel
confidence in the AR regulation.
They feel strong, so there might be increased spending. And if the US consumer does start spending, hold on, we are moving. The economy will move quite strong over there as well. But that's that jobs and unemployment challenge that we're talking about there in terms of those higher prices, and also how many of these people are going to be employed if AI is going to do a lot of the heavy lifting for them. So let's now move into China. We'll do a quick wrap on China. There's not a lot to report on China, so we'll get through the China numbers reasonably quickly. China's consumer price dropped by 0.4 year on year in August, after being flat from the previous month and missing market expectations of a fall of 0.2%. So you can see it there. It's absolutely deflationary.
Deflation is incredible.
The trend is they just can't stimulate their own economy off the back of that, because no one's buying their exports, because, well, their biggest market being the US isn't buying their exports. So they're obviously dumping into other markets. That means those other markets are potentially getting good prices.
It also means they're not buying their own stuff.
No, well, they're not, definitely from a consumer point of view. So that meant that the PBOC, the People's Bank of China, kept key lending rates at record lows for the fourth consecutive month during the September fixing period. That's in line with the expectation. The move followed the central bank's decision to leave the 7-day reserve repo rate unchanged in September as well. The decision came amid easing Sino-US trade tensions, even as growing signs pointed to a loss of momentum in China's economy in August, alongside US monetary easing as well. So nothing really to see here until we see a deal done between the US and China in terms of that. The unemployment rate, well, we don't know whether we can trust these numbers, but the survey of unemployment rate edged higher at 5.3% in August compared to expectations of around 5.2%.
And the reason we say we can't trust it, there are the granular details no longer published. Like the people under 30 and what they are, there was
the youth unemployment.
Youth unemployment was 1 in 4. It's probably higher than that. There are other things that makes this very hard to stomach.
Yeah, and we don't have a lot of media in China reporting on that. Even the ban, the ABC and so forth in terms of telling that story. And you can see it also showing up just quickly in their consumer confidence. So China's official NBS manufacturing PMI inched up to 49.4 in August from its July 3-month low of 49.3 and falling short of market estimates of a 49.5. So they're struggling with their outputs. They've got some real challenges in their broader economy, and that's why here's how we've wrapped it up. We've said the the China economy continues to battle on both the domestic and the international front, internation front.
Mm-hmm.
Sorry about that typo. A constructive trade deal would be good between these two nations. So it also would be good for the US, to be honest.
Yep. And indirectly good for us.
Correct.
But at the moment, as I said, there is no sign that they're close. But one movement on Truth Social could tell us another thing. So we will move on to
one
Europe.
post.
Yep.
All right, here we go. Okay, the euro area did report their quarterly GDP data, so we'll start there first. So Q2 GDP released was in early September, showing the euro area economy expanded, scratched out some growth of 0.1% in the second quarter. In annual terms, GDP for the euro area has expanded 1.5% year on year, and that's higher than the 1.4 in the initial estimates, and following an upwardly revised 1.6 in Q1. The largest contributors came from household expenditure and changes in inventory, followed by gross fixed capital formation, as well as public expenditure. So that's what's driven this particular story. What did that mean for monthly inflation? Well, they've hit their target.
Yeah.
They've done okay. Their target was 2%. They've got there. So euro area consumer price inflation stood at 2% in their August reading, slightly below the preliminary estimates of 2.1.
And holding, you've got to give them that as well.
Yeah, they've done well. They've done well considering they've done some cuts that we're going to see in a second.
Mm-hmm.
Energy costs decline more than initially thought. Headline inflation has now matched the European Central Bank's 2% target for the third straight month. So well done to landing that plane for the ECB in terms of what that looked like. In terms of the cash rate, you can see it there. They haven't changed the cash rate. So central bank has kept the 3 interest rates unchanged. So deposit facility at 2%, the main refinancing at 2.15, and the marginal lending rate at 2.4 as expected. So they're going to continue to keep monitoring that, and effectively they're going to be data informed, as we know, but they're determined to anchor inflation at 2% in the medium term, emphasising a cautious meeting by medium data-driven approach. And President Christina Lagarde said growth risk in the regions are more balanced and disinflationary process is over. So I think they've gone through that period.
Landed the plane.
They have landed.
That's what
threaded
they think.
the needle. Landed the plane.
But, and it is a but. I mean, this is a good chart. Their unemployment rate is back to a level that is actually quite good, and they have done very, very well. It's interesting when you put a politician into a technocratical role where they actually turn around. So Christine Lagarde is obviously the former finance minister of the French Republic, and what comes through in this data, though, is that areas that have been a massive problem, Spain, which we saw before, is taking off GDP-wise, Portugal, Italy, have got governments that have been a little bit more stable compared to their previous. I mean, again, I say that with tongue-in-cheek.
Well, there's a bit of nationalism creeping in there, but let's just have a look at in terms of the unemployment rate in Germany, 3.7. So that's pretty strong. Netherlands, 3.8. record lowest jobless rates, followed by Italy at 6%, France at 7.6%. So that's a big one.
Italy's the interest, as I said, Italy and Spain. I mean, again, it's a 10.1, but it was coming from 16.
Yes.
So that explains this big drop off that you're seeing. Yep. But Italy's the interesting one because Italy has gone from 9 to 6.
Yep.
And it's amazing what happens when you actually have stability coming into it. Now, it's not an economy I'd put up in the word saying stable very often.
And a baby boomer global population that is traveling through Europe, which is absolutely helping. Make no mistake.
So Italy's been an interesting aberration, I think is the term.
Yeah, because their domestic economy and so forth. Because here's the business economy confidence sort of story. So we saw business confidence in the euro decrease to negative 0.72 points in August from a negative 0.71 in July. But you can see the trend there. I think internally they've sort of given up with the amount of regulation and so forth that we're seeing in this particular area of the world. And obviously in terms of their well-meaning policies that have unintended economic consequences as part of that as well. So, if we wrap up the euro area, Europe is Europe. There's very little that changes over there. They're very old economies and very old civilizations. The political divide is the fascinating thing there. There is political instability and the rise of nationalism, and immigration is becoming a hot topic over there. And so we've got to watch that because that, to your point, if you take that stability out, you lose the confidence of the people, but you also lose the confidence of the business investment that might be going in there thinking, I don't know what we're going to get here.
And they can't get away from their own interference.
Yeah.
Like Europe is the most regulated place on the planet.
Yeah.
And as you said, they're ancient economies and regulation, therefore, has been not just coming for decades.
And progress is slow because the EU is basically a
slow
talk fest.
Yeah, it's very and this is the thing, when we say EU, it's a bit like saying the United States of America. That is actually still a country. The EU are 27 nations trying to work as a unit, and they're very different. Even though they are close in some areas, it's not as simple as that. And that's why, Germany has massive issues with what goes on in Spain and Italy, and Italy has massive issues with what goes on in the northern European states, because they think differently and they act differently to what they would do to certain situations. And that's why the euro area is fascinating, because it has been a social cultural experiment for good reason. Global world wars, etc., for decades, millennia, etc.
Combined second biggest economy in the world.
Yep.
So they've got that in their favour in terms of the euro. But it's this economic torch. What's going to be the catalyst for stronger growth and stronger prosperity? I don't know the answer to that.
And that question, I think, is being semi-answered by some of the reactions to the periphery nations that under normal circumstances where they could have depreciated their currency or could have brought in cheaper taxation systems to attract labour or to attract services into their nations, they can't do under the full suite of regulation. And so you look at a Hungary and the sort of pushback.
Exactly.
You look at those Eastern Bloc countries. You look at a Czechia, and how many times it's changed. Slovakia. They're the ones that you can just see it just going. Actually, if we were able to do what previous nations or nations like Australia can do, which is add deregulation, change tax laws without having to tell New Zealand and tell Singapore and tell Malaysia and tell Indonesia, being the Oceanic Asia region that we are a part of.
It's interesting. I mean, obviously,
that's their problem.
That's why the UK had the Brexit.
And it hasn't worked for them. But you can understand why it's happened, but you can also understand why that right populism is coming, because previous economic levers are not available to them.
No. So we've done the rounds. So let's just wrap up this episode of our September Economic and RBA update. November RBA is a live call. So we do know about that. The Australian economy is doing okay, but it's because it's being propped up by government spending. So let's hope that, the consumer and the private sector can take over. So thanks, government. We've got it from here. Pay down a little bit of that debt without increasing too many taxes. Property prices are definitely on the rise. So they will rise even further. Conditions are primed for that. We do expect off the back of that if there is too much animal spirits from the investor that we'll see government intervention stepping in. I think the first area of that we'll see that is APRA in terms of the throttling that they might introduce in terms of size of loan book growing for some of those larger lenders. The Trump experiment, which we've been talking about for the whole year, the economy, the US economy is in an interesting crossroads. So we're seeing some positives and negatives. So build it and they will come is the sort of Trump message to the rest of the world, but it's also impacting at the moment on the consumer and the population base already in the US. China's in a hole, best way to describe it. And then Europe is frozen in regulation.
Which is the best way to describe it. As always.
And of course, this is not advice. Please make sure that you seek out appropriate professional advice from licensed professionals in the area if you are looking to make any of those types of investments. And of course, yes, Empower Wealth is an advisory business, and we do advice around residential property as well as other investment assets. So if you want to learn more about what we do, feel free to visit our website. Learn more about us there. The Property Couch podcast, of which this will now be a recording on, you can check out some of our other episodes on there, and our more money management platform, which Evan is one of our great ambassadors for. You will also be able to access that free of charge. Download the app from either the App Store or your preferred App Store or Android store, or you can also download it through a web app on your laptop as well. So hopefully that gives you a bit of a wrap. Thanks, mate, for this one.
See you in November.
November, well, it's a public holiday here, so we'll have to work out what's going to happen. But we'll be there. We'll be around.
And remember, 29th of October, put it in your diary.
Inflation.
The binary outcome that will.
Yeah, whatever that says, if it's softer and not as hot as this read, we might get a cut. If it's a little bit heavier, we're going to be going into Christmas without a rate cut.
Yep, we are done and dusted. 3.6, lock it in.
Lock it in. All right, thanks, everyone.